Hello there, everyone, and thank you so much for watching with us today. I'm Sam, and I moderate these weekly presentations. And in just a second, we'll be joined by Michael Corgett, one of our financial advisors, who's going to be giving you a quick rundown of how interest rates are currently affecting your lump sum pension payout versus taking an annuity when you decide to leave your company. I apologize in advance. We do not have time today to take questions, but please feel free to continue asking them in the Q&A box. It's completely anonymous, and I will make sure one of our financial advisors addresses them with you either through phone or email once this presentation has ended. Quickly want to remind you, we are not affiliated nor endorsed whatsoever by any specific company. We are a completely independent group of financial advisors here, so keep that in mind as you're listening along. And lastly, we will be entering some links into the chat. They will pop up on your screen as you're watching this webinar. Please feel free to click on those. They're going to guide you to our calendar where you can book an appointment with one of our financial advisors, as well as to take advantage of our complimentary cash flow analysis, which Michael will go more into depth with you about, as well as a link to follow us on YouTube, where we post much more Fortune 500 company employee related content weekly. So please take advantage of that. And without further ado, let's jump right into it with Michael Corgett.
Thank you, Sam. I appreciate it. My name is Michael Corgett. I'm an advisor here at the Retirement Group. Welcome to today's presentation. This is probably one of the most interesting presentations for folks who have the opportunity to take a lump sum versus taking an annuity. And that's what we're going to talk about today, is the various pension distribution options in the simplest of ways, and then our advice to consider with the differences between lump sum options and annuity options. So let's go ahead and get started. Again, we're going to talk about the various pension distribution options that are available to some of you, not all of you. Many of your employers only offer annuity options of various types, but some of the employers that we work with do also offer a lump sum option. So the single life annuity, the various joint and survivor annuities, then the lump sum options, and then we're going to talk something about the look back period for interest rates. The single life annuity is the number one annuity. This is what all options are going to be based on. It is number one. It is the largest monthly pension option that you could take as far as dollars, because it is only based on your life, the retirees. All other options are going to work from this point in time. It does basically pay you a fixed monthly income for the rest of your life. Most of the corporate pension plans that we've dealt with over the years have no cost of living benefit built in. So if it's $3,000 when you start, your benefit in retirement, it'll be $3,000 20 years from now. The joint and survivor options are just that. Your annuitant survivor, whether it's your spouse or someone else that's important, if your pension allows you to do that, is going to be a reduced benefit. You will take a smaller benefit to provide a percentage of that benefit to your beneficiary, your spouse again, or another annuitant. The more money that you choose to provide your spouse again or the other annuitant, the less monthly benefit that you will receive. To give you a couple of examples, think of a single life annuity as $1,000, and you choose to take a joint and 50% survivor benefit. Your benefit's going to be reduced by approximately 10% for your spouse or joint annuitant to get 50% of that monthly benefit if you pass away. Now, I want to point out that most pension plans do offer what's called a pop-up provision, and that provision allows your annuity benefit to pop up from whatever joint and survivor annuity option you chose to the single life annuity amount if your spouse happens to predecease you. But going back to some of my examples, if you went to a joint and 75% survivor, that would more than likely reduce your benefit by 15%, so your spouse would get 75% of that benefit. And then finally, a joint and 100% survivor benefit, you would get about an 80% of your single life annuity. Your spouse would get the same monthly amount. There are other options that many pension plans offer, like period certain. which would be a smaller single life annuity. But if you passed away during the period certain, which could be, let's say, 10, 15, or 20 years, your beneficiaries, whomever they are, would collect the balance of that period of time. So there's all sorts of options to consider as far as the annuities are concerned, but I just wanted to touch on the basics. And then let's talk about lump sum options. Lump sums payments are an actuarial calculation based on the single life annuity. Now, it's also based on interest rates and your life expectancy. There's actuarial factors that are applied that will affect the amount of the lump sum. And if you choose a lump sum benefit, there is no death benefit payable to you if you die from the pension plan. You will have taken the lump sum, hopefully rolled it over into an IRA, and there would be a death benefit to provide your beneficiaries at that time, as long as you invested it conservatively, the right way, and you're not withdrawing too much money in retirement. But those are the flexibilities that you have with a lump sum option. You don't have to live within the framework of the monthly annuity benefits from your employer. You could choose to take more or less different amounts each year. You could give yourself a raise by increasing the amount that you're taking every year, if you'd like, by a couple of percentage points just to keep pace with inflation. All these sorts of things are available to you. But I think the most important thing that impacts lump sums are interest rates. So think of a lump sum and an annuity as two different mortgage payments. And what you see here is that the $1,950 a month mortgage payment or annuity amount is going to make a payment on a smaller amount, $480,000 at a 4% interest rate. You'll notice if the interest rate is lower, the borrower can get more money to buy a house, or $462,500. So that's the true benefit of lower interest rates. The look back period is just that. Most pension administrators will look back in time to a specific point in time, and from that point they'll look at the segmented interest rates that are published by the IRS on a monthly basis. For example, one of the companies that we do a lot of work with, again, those interest rates are published by the IRS every month. That company will lock in their interest rates for the next year with the November rates. So here we are in November of 2024, and that company will look at what those rates average out to be at the end of this month. And whatever those rates are, they're going to go into every lump sum calculation for 2025. One of the benefits of that is that you know going into the next year, if you're considering retirement, you could run calculations and you'll know what your lump sum benefit is going to be. You don't have to wait for interest rates to come out in the month of February if you want to leave in March. So again, those interest rates are typically looked at in a previous year or a previous period of time. Some employers look at these rates quarterly, and then whatever those rates are will impact the lump sum. These interest rates obviously go up and they go down. And we have been in a very high interest rate environment for the past couple of years. Everyone remembers COVID. Interest rates from the Federal Reserve were at zero. Lump sums in 2020, 2021, and in 2022 were basically about as high as they've ever been because the segmented rates were about as low as they've ever been. But inflation started kicking in. The Federal Reserve decided that they had to start raising interest rates. So the rates went up in 2022, at the end of 22, and all the calculations for 2023 were a lot higher. And lump sums dropped by anywhere from 20 to 30%. And rates have continued to go up, so calculations for this year the lump sums are even lower than they were in 2023 because those segmented interest rates continue to go up. So a lot of you saw continued reductions of 5 to 10% more on top of the 20 to 30% you lost in the previous year. So many of the folks that we're working with are certainly not interested in taking the lump sum benefit because they've taken such a big hit. But as you can see here, the segmented rates are beginning to go down. And the latest rates that were published were in September. As you can see, 4.17 is the first segment, 4.76 is the second segment, and 5.25 is the third segment. So these rates are starting to inch down, which are having positive impacts on lump sums going into 2025. I will say, compared to last year's interest rates, you could look at possibly a 6 to 10% increase in your lump sum for 2025. Also keep in mind, if the Federal Reserve does continue to lower rates, which affects all interest rates, including these, next year, lump sums could even be larger in 2026 than they will be next year. So these are just things to keep in mind. We would love the opportunity to talk to you more about your own specific situation. I think the most important thing that people should do is have a written financial plan. And a lot of Americans don't. It's a complimentary service that we offer to anyone who is interested. All you have to do is contact us. You can reach out to our firm at 1-800-900-5867 or send us an email or give us a call. We're a team of advisors with a great deal of experience. We have offices nationwide. I'm based here in the Midwest, by the way, but I have clients all over the country. We have a good knowledge of your pension, your 401k, and your medical benefits for a number of Fortune 500 companies that we have focused on and niche marketed to for years and years and years. And I've already mentioned the complimentary cash flow analysis. If you want to schedule a meeting, you could scan the QR code here on the left. Scan the one on the right to follow us on our LinkedIn page. Amongst other things, we have our future webinar schedule on our page. We have a lot of a lot of good information, articles that we publish on our page. If you've got any questions after this presentation and we don't get to you, you can also call our office. I mentioned that already, or send us an email at info@theretirementgroup.com. I was kind of quick about this, but I wanted to get a general understanding across to all of you. Again, the annuity options versus the lump sum options, one may make more sense for you than the other. You have to look at your own situation. That's the most important thing. And whatever makes the most sense to you is the option that you're obviously going to choose. And having a plan will help you to make that decision. If you got a written plan, you'll be better off even if you're 5 years from retirement, because you'll know where you stand today versus, let's just say hypothetically, you get an email and you're going to be laid off in 2 weeks. That's frightening, number one, but knowing what your options are, or not knowing what your options are, I should say, that's a big deal. So I want to thank everybody for joining me today. I appreciate your time. I look forward to talking to some of you in the future, and have a great day.